There are over 1.2 million retirement millionaires, and today we're going to show you how to become one. As of late 2025, Fidelity reported there were 654,000 401k millionaires and over 559,000 IRA millionaires. And that's not even counting defined benefit plans and other retirement accounts. So this is not about picking, hey, what's the hot new stock? It's about understanding which account you're using, who can sponsor it, and how much you are allowed to put away. You might be surprised. You can put away hundreds of thousands of dollars a year in some of these plans. And so I brought in an expert. So Eliot, welcome.
Thank you. Good to be here. I'm Eliot Thomas, Manager of Tax Advisors here at Anderson.
And I'm Toby Mathis. I'm one of the founders of Anderson and a tax attorney for going on close to 30 years. All right, Eliot,
yes.
Let's dive right in. Can you walk us through the basic difference between saving in a taxable account versus using an IRA or a 401k?
Absolutely. So I think you nailed it just starting out there. It's a taxable account. That's your traditional brokerage account that you have outside of a retirement account. Every time you make a trade, you're having a taxable event. Big difference there. You're going to pay taxes on all of those gains, each trade that goes on. They also break it up between short-term and long-term. They're making a difference in how it's taxed. If you've had that particular stock for less than a year, it's going to be at ordinary rates. We call that short-term capital gain. If it's something that's over a year, you're going to have long-term capital rates, and that could be 0, 15, or 20%. But whatever it is, it's a taxable event.
All right, so those of you that are like opening up the Robinhood or the Fidelity and you just put money in it and you're not specifying, hey, it's a Roth, it's an IRA, it's not put through an employer plan or it's not a DB plan, you're in, chances are, a taxable account, which means you're paying taxes as you go, versus, what's the alternative?
Alternative, you're going to have retirement type instruments such as an IRA, just stands for individual retirement arrangement or account, pretty much the same thing under the code. Or a 401k is another popular example. Again, both of these are retirement ideas where you've put money in. Maybe you got a tax deduction. If it's a traditional, you can possibly get a deduction against your ordinary income on that amount you put in. Or if it's a Roth component, then you don't get a deduction when you put that contribution in, but a gross tax-free, and later on at retirement, you can take out the distributions tax-free.
All right, so we have a couple different flavors. Mm-hmm. So, but the real gist is you don't pay tax on the gains as you make them. So whether it's a traditional IRA, a 401k, a Roth IRA, a Roth 401k, defined benefit plan, cash balance plan, all of these have a tax deferral mechanism so that you're making money inside them without having to pay tax as you go. You may pay tax at the end. Sometimes you pay tax at the beginning, like in a Roth. You get no deduction, but then it grows tax-free and you never pay tax again. Or HSA, which we didn't really, it's not really a retirement account, it's a health savings account, but you get a deduction going in, you never pay tax on any of the growth, and as long as it's used for medical, you don't pay tax ever again. Like it's literally a triple threat. Mm-hmm. All right, so we just hit on a bunch of things. Mm-hmm. So let's go over the difference, because some people are familiar with an IRA, but what makes a 401k fundamentally different than an IRA?
The biggest difference is that the 401k is required to have a sponsor. Think of an employer. It's got to be your business. Typically an LLC maybe taxed as an S corporation or a C corporation, but it's got to be your employer, and that's key. It has to be a business of that nature, and you are the employee. That's another big difference between IRA and 401k. Two different streams of contributions, one by the employee, and we got certain limits on that under a 401k, and then also a contribution maybe under a solo 401k by the employer as well. Two different streams coming in.
But they're huge difference in limits.
Absolutely.
The IRA is capped at $7,500?
Yep, about $7,500, $1,000 catch up if you're over 50. But compared to the Roth, or excuse me, the 401k, we're looking at $72,000 for 2026. Quite a distinguishment.
And then there's different types of plans that even go far beyond that, which we'll get into. All right, can you explain why the employer sponsorship matters so much.
It does. This is really the IRS, the government coming out with a carrot and stick approach. They're saying, we don't mind you putting it into plans, but it's got to be from earned income. Here, under the 401k, they want to also encourage businesses, employers to put into plans. That's why we have the amount being put in by the employee, and then up to 25% of your compensation can be put in by your employer as well. So if you're a sole proprietor or have your own S corporation, you get paid a paycheck, you can put in, you can contribute out of that up to $24,500 in 2026. But also, as an employer, they can put up to 25%, get a deduction for it, and put that into your plan as well.
25% of your compensation.
Correct.
All right, so let's make this real simple for folks. So if most people are used to an IRA, so the individual retirement arrangement, I can put in $7,500 and take a deduction on it per year. Your kids can do this, anybody can do this, as long as they have earned income. If you make too much money, though, you can't on an IRA. Like, they won't let you deduct it. They'll let you put it in, but they won't let you have a write-off. And that number is...
It's really low, relatively speaking. For a single, it's between $81,000 and $91,000 where it phases out. So by $91,000, if you're putting into a traditional, you're not getting any deduction when you put into it. Whereas for a solo 401k, there isn't any limit. You can go ahead and put it. Now, Mary finally joined again on the other, $129,000 to $146 for IRA.
But so there's a phase out.
Correct.
And all that means is, hey, if I'm putting in $7,500 into an IRA, whether I get a deduction is partially based off of what I make. That does not exist for a 401k. I could be making $1 million a year and I can still contribute without having to worry about whether it's deductible or not. Now, some people will put money into an IRA, then they do the backdoor IRA and they convert it into a Roth, and I don't want the deduction. I just never want to pay tax on any of that growth again. But that's one side of it. I want to go back to the employer side. So let's talk about 401ks. So if somebody is self-employed, let's distinguish between a traditional 401k and something called a solo 401k. And why is there a difference? And is it really a difference?
There is a difference. From a tax perspective, the solo 401k is required where you just have one business owner and maybe a spouse, possibly a business partner and their spouse. But we're talking about a very limited number of employees, and they really have to be owners or their spouses. Whereas your 401k, if you have employees, well, we can't do the solo 401k. We have to go with the traditional 401k. Why do we care? It's a lot more expensive to have a regular, traditional 401k as opposed to the solo. A lot more administrative costs and things of that nature.
So solos are relatively easy, and I believe they also come with a tax credit now, so they're almost free. And if it's, again, just you and a spouse or you and a business partner, maybe you can get into the solo.
Correct.
And it makes it really, really easy. But then if you have other employees, then you're out of the realm of using the solo. You're into some deeper waters, and you're using a traditional 401k. It really comes down to what about? Just the administrative cost of running it?
Yeah, pretty much. Mm-hmm.
All right. So for a business owner, let's think about kind of a progression. Some business owners, they just put money into a savings account. They're just like, hey, I just got to save money. Then some people are like, oh, if I'm saving money, maybe I'm using an IRA, maybe using a SEP or simple. I'm using some other type of retirement plan versus eventually I go to a solo. What do you see? Like, what is that progression?
I think that when we start with just basic savings for our business, you're building your war chest, getting some dry powder in case, rainy days come. But once you have enough that you feel that there's a sensible amount that you have in reserve for your business, then you want to start looking for some deductions, maybe an IRA or something like that as an individual, with your own business or something of that nature. When do we switch from an IRA over to a solo? Well, certainly if we're at the level of income where we're phasing out, we get no benefit from it as far as deductions, that would certainly be a sign to maybe switch over to the solo. If we have a lot, as more income comes in, you have more that you want to contribute, that you have the ability to contribute, that's probably when you're going to switch from your IRA to your solo 401k.
And I just kind of want to hit on this. You're talking about, hey, there's these big deductions. You actually have another realm you can walk into where you're able to write off hundreds of thousands of dollars a year called a defined benefit plan. But usually you're going from this idea of, hey, I'm just putting some money aside, and it's very accessible, right? The reason that we like using savings or something is because it's easy to get to. Then you go to the next step where you're saying like, hey, I have a little bit of extra and I'm feeling comfortable. I want to put some of my money aside, and it's still pretty accessible. Like there's this misnomer that if you put money into like a Roth, you can't get it back out without a bunch of penalties. No, I can always take the money I put in out without a penalty. If I put money in and take a deduction on a traditional IRA, there might be a penalty for taking out, but there's lots of exceptions, especially when there's an emergency.
Correct.
But one of the things that makes 401ks and IRAs and DB plans so effective is that there is friction to get your money back out. So you do want to make sure that if you're putting money in, that you're willing to say goodbye to it for a long time, because that's where the benefit comes in. It's not interrupting the compounding that's tax-free over a period of time. Do not interrupt it. Allow it to do what it wants to do. In fact, there was a great study, I think it was Hogan and the Ramsey Institute, did over, I think it was 10,000 millionaires. The number 3 profession for millionaires underneath that study, so they looked at 10,000 millionaires, was teachers. And these are people that were not making a ton of money, but they still ended up being millionaires. Why? Because they put money into their 401k, and it was, again, there's a friction to get it back out. And that's what we like to see. And it makes people kind of a forced savings. Your employer's putting the money away. Sometimes you're putting the money away automatically. That's a very effective way to become a millionaire right there. I used to joke that the cheat code to becoming really wealthy is to open up an account at like a Fidelity or a Schwab or whatever, Robinhood even, and put it on auto invest, where it automatically takes the money out of your account and automatically invests in a particular security or an index, and then lose your password. Because in 30 years, you're going to be a stinking millionaire, statistically, if you just get out of your way. If you put a little bit in every week, you'd be surprised. It could be hundreds of dollars. And yeah, you do it long enough, you're going to be very, very, very happy. This is kind of a cheat code, because if you set up your 401k, you set up your defined benefit, you set up IRA is a little different animal. I'm just going to stick to the 401ks and the DBs because those are the big guns. And you set it to where it's automatically taking these things out, you'd be surprised. You could get there in a matter of years, like not 30 years. You might be shocked, especially in DB plans. Sometimes we see people getting there in as few as 5 to 6 years.
Warp speed.
Yeah, warp speed. We actually have clients that put in over $700,000 a year in tax deferred into those. And before, who's the guy on 10X guy, whatever, he's always like, you're stupid to have a 401k. You have to pay tax when you get it out. Now, you're going to be at a much lower tax bracket when you're getting it out. Yes, you have required minimum distributions, but if that's what you're worried about, I think I'd be worried about the 37% tax bracket a little bit more, right, and getting it into a tax-free zone. All right, so let's go over this. The 401k, the solo 401k, these are defined contribution plans.
Correct.
Where we're defining how much we could put in. Why don't you kind of go over what what are the different things that they can use? So we're going from IRAs to solos, but there's a lot of people that go from just having the IRA to go into the 401k, then the DB. What do those numbers kind of look like, and who should be considering these things?
Right. So again, kind of what, as we were talking about earlier, as far as when to go maybe from savings into a IRA into a 401k, it's the same type of principle. As we're making more money, we might want to look at a bigger plan. IRA again, if you're making, first of all, you have to have that earned income, remember, to put into the solo. But if it's a lot more income, if you're seeing a lot heavier W-2 coming out of your business, perhaps it's an S Corp or C Corp, then maybe around $25,000 or something or more.
I want to emphasize this, by the way. $25,000 a year profit, you might want to be looking at a 401k, because you could literally pay it to yourself.
Mm-hmm. And then put it right back.
And put it right in. Or if you're a sole proprietor, A, don't do that. B, if you are and you're making money, that could go straight into a 401k, because it's all considered compensation. Mm-hmm. But you can put aside over 20, let's just say 20, we'll say 25 is the magic number, but you can put in, I think it's 24.5, right?
Correct, 24,500.
From the employer side, directly in and avoid federal income tax.
Yep.
Boom.
Yep.
And state income tax.
Right, and that for if you're in an S corporation, it'd be 24,500 as the employee, and then the employer can put into 25%. That's the corporation. It can put in 25% of your compensation level.
So let's I want to make sure people understand this. So let's just say you're making
100,000.
Okay, let's do 100,000. You could put 24,500 in as the employee, which means I never got the money. They ran it through payroll directly into the 401k, and then the employer can make an additional contribution
Up to 25%. If our W-2 was 100,000, that'd be another $25,000.
All right. And so we're close to 50 grand that we managed to put in. Are there plans that allow us to even do bigger?
More? Yeah, absolutely. There's a lot of ways. The defined benefit plan being one. Defined benefit plan is kind of the steroids of your retirement plans. Basically, they change it each year like anything else, the limits, but you're defining the amount of the distribution, the benefit. That's why it's called defined benefit, how much you're going to get each year at retirement that you're going to receive. So you have to have an actuarial come in. They're a little more costly, but for 2026, they will calculate so that you can have up to $290,000 coming out every year as your benefit from that plan, or you can take a lump sum of $3.7 million.
Yeah. Again, let's look at this. So let's say you're making $100,000 a year. They look at the 3 years. The actuary says, all right, in order for you to receive that much money when you retire, so it can go up to $290,000. But let's just say I'm making $100,000 a year. They're going to calculate and say, Toby, how old are you? How long do you have before the end of retirement? And this is how much money you would need to have in that plan to make $100,000 a year in retirement. That's going to be a large amount of money. That's not going to be $7,000 a year. This is going to be in addition, by the way. You do the 401k and you could add the DB plan.
Absolutely.
But you're able to put hundreds of thousands of dollars. In my case, if it's 100 and I'm older, even though I'm only making 100, I, in theory, could be contributing a lot more than $100,000 a year because I have so much to catch up. I may say it may be a number of like 2 million or something, whatever it is that the account needs to have in order to pay me this much money every year. I may have a very short period of time. So let's say I have 10 years to do it. I'd be able to put in about $200,000 a year. And now you guys are saying, well, wait a second, you're only making 100. Yep, I could pretty much dump my entire salary straight into there. I might have to take more, which is okay. I'm not paying tax on it, right? But I have the ability. I don't have to put that much. Usually it's a range, but I can put a big chunk. Speaking of other big chunks, if you're older, if you're 50 to 59, you can have a catch up on a 401k. What is like
$8,000 currently, and then we have the super catch up if you're 60 to 63, $11,250. That's extra above that $24,500 as the employee that you can put in.
All right, so some of you guys, your heads might be spinning, and you say, oh boy, what do I do? Number one, you can always come to one of Anderson's tax and asset protection events. We teach them almost every Saturday. I'll put a link. They're absolutely free. They're really great. They're really geared towards investors, especially real estate investors, but business owners also get a lot out of it because we're talking about asset protection and tax planning and legacy planning, all three during that. Number two, if you want to just talk to somebody and say, hey, what's available to me? What type of things should I be considering? I'll put a link to have a free strategy session. Are there any other examples you want to go over?
We can. One example we have a lot is maybe if you're a sole proprietorship, when do I want to go to an S corporation? Get asked that a lot. Just pulling back on that, there's a lot of instances of or reasons why you want to go from one to the other, but strictly speaking with our topic today, 401k, solo 401k, one thing to be aware of on your Schedule C is a sole proprietorship, we don't get that 25% of our compensation, if you will. 100% of your income on a sole prop is your compensation. But because of the rules and you're self-employed, you only get to take 20% of the net income because of employment tax issues. So really, if you had $250,000, let's say, of net income coming through,
you need to be an S corp.
Yeah, you're going to want to be an S corporation because you can only put in about $47,000 when it's all said and done. And after taxes of about $53,000, whereas if you're an S corporation, You have two streams of income. You can put in as an employee and as an employer. You can put about $49,500.
All right. And then there's some of these higher end strategies that you hear about, the mega backdoor Roth. What is that?
All that is a way to get in. Again, we're going from traditional, where maybe you got a deduction for putting into a plan. Whereas you move it over into a Roth, the idea is it grows tax-free, and then when you finally take out, you don't have to pay any tax on the distribution.
You get no deduction for putting money in, but you may not have, like a lot of 401ks, they'll have a Roth component, and it's the same $24,000, unless you're older. But let's just say it's 24, you're under 50. So what are you doing to get $72,000 a year into a Roth? It's possible, but what are you doing?
So what you're going to do is you're going to contribute as the employee of a 401k, solo 401k, your $24,500, make that contribution. Your employer can put in their $25,000, again, assuming $100,000 of income of compensation. After tax, that means that $49,500 been put in. That leaves $22,500 that you can put in as the individual with other after-tax money that you have. So other cash amounts you can go ahead and put in. So you get up to that maximum of $72,000 that is contributed. That $22,500 of after tax, you immediately roll over into a Roth component, put it into a traditional, move it over into a Roth. So you've been able to put that into it. You can roll over your $24,500 that you put as an employee. And your employers actually now, after Secure 2.0 Act, they can actually contribute to a Roth on your behalf in some special solo 401ks, as long as the plan provides for it. The law allows for it, but does your plan? You always want to look at that. And now you got $72,000 immediately into a Roth.
Yep. So the easiest way to think about this, I'm simple, so I like buckets. You have the employer in contribution, you have the employee contribution, and then you have the Roth bucket. So there's the tax deductible contribution that goes employee, tax deductible employer contribution. But during the year, before the end of the year, you roll them both. And your plan has to allow this. Anderson's plans do, so just so you know. But you roll them both into that Roth before the end of the year. And then all that happens is you have $72,000 sitting in that Roth bucket. How much tax have you paid? Nothing, because the end of the year is now. You're not going to get a deduction for it. But now you have $72,000 sitting in a Roth bucket that's going to grow tax-free forever. Like, you're going to be able to take that money out. When you retire, tax-free. The growth is tax-free. You're never paying tax again. So it's a huge benefit.
It really is.
All right. Anything else you want to cover on the 401ks?
Well, we talked a little bit about already the defined benefit plan, but we can attach components of a solo 401k onto that as well. Again, the DB plan, defined benefit plan, you get to put a whole lot into it. It's calculated on what your payments, your compensation for the last couple of years are, as Toby was going over. And this is a deduction by the employer. Your business is what puts these large chunks in there. But also you can couple onto it the solo 401k. So as an employee, you can put your $24,500 as well onto it. And the business can also put into the profit share portion. That's the employer portion of the 401k. It's much more limited because remember, it's making the large contribution, but it can do up to 6% of your compensation amount.
Okay, so at the end of the day, what we are looking at is somebody who's making good money. So I'd say over $100,000 a year. But if you're making $300,000, $400,000, $500,000 a year, you can take huge amounts of that and dump it in because the actuaries are calculating it on your ability to receive. Right now, the maximum amount is, so you might be making $500,000 a year. And you're saying, Toby, I want to make $500,000 when I retire. They can't use the $500,000. They have to use the maximum amount of benefit, which is about $290,000, which means there's a big chunk of money. It's usually somewhere in the neighborhood of $4 million right now that needs to be in that plan. So let's just assume you have 10 years and you got nothing in the plan. You'd be able to contribute somewhere in the neighborhood of $400,000 a year, tax deferred, into that plan and get this huge deduction. Plus, you have your solo 401k as well. So like when you add those things up, you can end up being in a great situation where you're basically avoiding a lot of the tax on your active income. Maybe you're living off your real estate. Maybe you're living off of other investments. Maybe you're living off of your dividends. If you follow me, you know that's a big thing. Maybe it's short-term capital gains from options. But you say, hey, the last thing I need is to get hit with all this, with all this ordinary income. I'm just getting crushed in taxes. That's how you do it, is with these DB plans. And so so I think we just did a big progression. We did IRAs, 401ks, the difference between solo 401ks and traditionals, and then on over to DB plans, and then we played a little bit with the mega backdoor Roth, which means you have some flexibility as to where you put these things in the end. All right, anything else you want to cover?
I think that's about it.
All right, perfect. So guys, you now know why there's so many people that are millionaires with retirement accounts. Now you know exactly how you can join. Again, go to the Tax and Asset Protection Workshop. There's a link in there. Schedule an appointment if you want to talk to somebody about your specific situation. It's free. Good luck.